Good day. In the next few minutes, I would cover a question in management, international financial management, asked by Visvesvaraya Technological University in its paper of September 2014, question 5C. It's on management of translation exposure. So the given items are, as per the balance sheet of a company, cash, all in million rupees, cash 100, marketable securities 100, debtors 200, inventory 300, L&B 600, plant and machinery, land and building is 600, plant and machinery is 800, furniture and fitting is 300, current liabilities 400, bonds 600, retained earnings 400, and share capital 1000, all in million INR, as I already told you. Now, how we would go about doing this is this numerical is as shown further below. Also given as the current rate of exchange is 50 INR for $1. 50 INR for $1, and the historical rate is 56 INR per $1. Now, what we will do further is we will write the particulars duly segregating the assets and liabilities. And there are 4 different methods of calculating the international translation exposure, isn't it? These are current and non-current, monetary and non-monetary, temporal, as also current rate. What are the differences in these kind of different methods? In current rate, all whatever quantities given are taken in terms of current rate only. And only the capital, except the capital, which is taken in historical rate. Then current and non-current method, other than the capital as well as retained earnings, we also will take any non-liquefiable entities, assets also, or liabilities also. Like, for example, you see here, bonds are taken as at historical rates. Also, land and building, plant and machinery, these are taken in historical rates. Furniture and fixture is taken in current rate because it's liquefiable, isn't it? Monetary and non-monetary also considers similar, and in that case it also considers the inventory as on historical exchange rates. See, and temporal method is more or less similar to monetary and non-monetary. So we take those exchange rates, current rate or historical rate, as prescribed per method, and then calculate against the what are the applicable exchange rates against the amounts given here. Here all these amounts against each account head, whatever has been given, we will take it against the prescribed exchange rate applicable to that particular accounting method or calculating method, and apply it. And like, for example, in current and non-current method, as we are seeing here, we have taken current rates for cash, marketable securities, and debtors, as well as inventory. And for land and building, plant and machinery, extra, we have taken the historical rates. For furniture and fitting also, we have taken current rates. So the total of we will, after multiplying with this given amount, the applicable exchange rates, the total what we get for the assets is 44.1429 million INR. Similarly, liabilities for current and non-current. Current liability we are taking as at current rates, and rest all three we are taking in historical rates. When we multiply the amount with the applicable exchange rates, the total assets what we are getting is 43 point something. When we deduct the total assets from total assets, we will we deduct the total liabilities from the total assets. What we get is the profit and loss as seen here against current and non-current method. Similarly, we calculate for monetary, non-monetary, where we get the total of assets as this 42.8571 and total liability as 45, and the difference that is loss is minus 2.1429. Similarly, temporal and current rate. Now, what we do, we calculate next exposure calculation. In next exposure calculation, the particulars and all the different methods, current, non-current, monetary, non-monetary, temporal, and current rates are written here. And in the exposed rates row, we add up the total conversions available under the current rates as per the current rates. Similarly, current exposed liabilities is the total of the liabilities calculated as per the current rates. When we find the difference between these two, that will give us the net exposure. Here we are calculating the net exposure based on the values we have received based on their current exchange rates only. We are not taking the any conversions carried out based on the historical rates. Here we calculate the profit and loss based on all kind of conversions, whether it was based on current rate or historical rate, isn't it? Now, so net exposure we have calculated like this under all the four methods, and net gain and profit and loss we have calculated under these heads. So it is not necessary that this profit and loss which we have calculated be the same as the net exposure we have calculated. They could be different. So I hope you understood the translation exposure calculation.